Most people lose money in trading not because the strategy is bad, but because they've never learned the right way to start. In the next few minutes, I'm going to give you a clear step-by-step foundational guide to get you started the right way in 2025. I've been trading for years. I've coached thousands of traders all around the world, and I see what separates the winners from the ones who quit. What we're going to do is break down in depth exactly what you need in order to start seeing success with a proven process that anybody can follow as long as you're willing to put in the work. By the end of this video, you'll know exactly what to trade, how to get set up correctly, when to enter and exit, and also how to manage risk like a professional, even if you haven't ever placed a trade before. Let's get straight into it. But before we do, make sure you subscribe and you click on the link in the description for our free Discord community, where we're going to be giving out some free resources to make sure that we can help you grow. So let's get straight into it. What's going on, everybody? So I want to welcome you to how to start day trading in 2025. By the end of this entire training, you're going to be able to, in the next 72 hours, be able to place a trade and most importantly, have a step-by-step blueprint to help you win in today's market. Okay, whether it's Forex, crypto, stocks, we're going to break everything down in depth. So let's get straight into it. So the first thing I'm going to mention, guys, all right, a little bit about myself. I've been in the industry of both Forex and cryptocurrency for about 10 plus years. Okay, I've had an incredible journey, both filled with super high highs, super low lows. But over the last 10 plus years, I've generated about $100+ million in educational revenue for a previous venture that I was a part of. I've mentored thousands of people in this space, and I've spoken on stages around the world. Guys, yes, I'm a trader, but I've also built businesses traditionally and also online businesses to 6 and 7 figures. So trading is something I love, something I'm passionate about. But I got involved in the industry, I would say, of entrepreneurship about 10, 11 years ago, and trading served as a different way to look at entrepreneurship. I look at trading as a business. And we're going to dive deeper into that later today when it comes to the psychology. So this is what you're going to learn today, guys. Okay, we're going to talk about what day trading really is in 2025, a great modern approach, some of the best tools and timeframes that you can use as a beginner right now to start using. Then we're going to talk about how you could build your first trading plan, your favorite starter strategy, and then we're going to go in depth with the psychology, consistency, and certain things that you're going to want to avoid in the market in order to be able to profit long term. So let's get straight into it. This isn't a get rich quick video, okay? So there's no Lambos, no flex, okay? No bullshit, excuse my language, but this is all about building a long-term skill. It's not gonna be just based off of any type of hype, okay? Losing in this business is part of the process, and I always say that winning is all about gaining consistency behind the skill, okay? You wanna treat this like a 2 to 4 year plan in order to set yourself up financially, okay, when it comes to gaining a skill, okay? They say that the law of mastery happens at around about 100 hours. That means if you put 100 hours into a skill set, you'll be better than 95% of people. So what is day trading, guys? Day trading is something where you're buying or selling a commodity, a currency, a stock within the same day, okay? And you're focused more on short-term price movements, and you're not taking any type of overnight risks specifically, okay? It's all based on patterns, timing, and discipline, and certain indicators and indications of whether price is going to move to the upside or move to the downside here. Okay, or how does the market really work? Okay, price moves from supply and demand, whether it's a commodity like gold or oil, whether it's a currency like GBP USD or Euro USD or USD CAD, whether it's a stock like Nvidia stock or Coinbase stock or MSRT, or whether it's a cryptocurrency like Bitcoin or Solana. Every single day, the value of whatever that is always moving from different types of supply and demand. Let's say, for example, during certain seasons, oil, okay, is at a huge demand. And then there's certain seasons where oil is at a very low demand. Okay. And the whole business is built on the psychology of understanding that supply and that demand. Between the buyers and sellers, that's where there is opportunity. Okay. And in that opportunity, it's all based off of where the areas of interest are to be able to buy low and then be able to sell high with the right type of structure. And the $1 million question is now, where can you buy low to be able to also learn when to sell high and then sell high in order to be able to what? Buy low.
So who is day trading for? I always say that it's for the self-starters who want to have some sort of time or location freedom, for pattern thinkers who enjoy strategy and in-depth thinking, because it requires a lot of mental focus and a lot of mental endurance when it comes to day trading. For also people that are looking to build a long-term skill set, like I said, 2 to 4 year plan here, but that doesn't mean we can't make money fast. And then also for people that are looking to learn from their mistakes and have some sort of awareness to grow on those mistakes here. Now, who is it not for? I say it's not for gamblers or impulse clickers, okay? If you're going to treat this like Vegas, look, you're going to make money potentially, but you're also going to lose money pretty quickly. Having a long-term plan here is the only way you're going to be able to survive day trading. You've got to understand this is one of the most lucrative ways to make money in the world, but it's also one of the fastest ways to lose money in the world. So just understand that if you're going to be a gambler, you're going to have negative impulses here, it's going to hold you back, and you're better off going to Vegas if you're going to treat it like a gamble. Now, that doesn't mean you're able to make money fast, because I say this isn't a get rich quick, but you could still make money fast. But that all depends on your skill, number one, and it also depends on your capital, number two. Anyone who could take a loss also without any type of rage quitting, okay? This is not for people who can't take losses, especially if they're super emotionally driven. Because if you're emotionally driven by the markets, you're going to get left behind and the market is going to take your money. Also, I say it's not for lazy people. You know, I see a lot of times people just want to go out there and try to copy somebody, or I would say learn this by themselves and not have to grow, learn the 1 or 2 step formula. Guys, the 1 or 2 step indicator isn't going to make you money or actually help you long term to really develop an understanding. I like to say trading is a real profession and it's not a hobby. It's something that you're going to want to focus on a consistent basis in order to grow. There are 3 types of traders. You have the scalper, you have the day trader, and then you have the swing trader. So scalper is somebody that's in the market. They might actually use some type of internal structure here. So if they're trading on the lower time frames, anywhere between, like, let's say the 15-minute time frame and also the smaller time frames, like the 5-minute time frame. They're getting in and getting out of the market, okay, on small movements, okay? And the thing about the scalper here is the scalper is somebody that's looking for small movements to get in and get out of the market, whether it's a New York session like over here, okay? And all they're looking for are smaller movements, okay, to get in and get out of the market, right? They're usually trading on the 15-minute time frame and below. Then you have the day trader, who is somebody that's going in and going out of the market within the same day. This is somebody that likes to potentially trade, like, let's say, New York session that happens between 8 a.m. Eastern time to 4 p.m. Eastern time, or let's say London session that happens at the London time at 3 a.m. Eastern time, depending on where you're tuning in from, plus. Or let's say Asian session that starts at 7 p.m. or 8 p.m. Eastern time, depending on where you're tuning in from in the world and what time you are right now. Now, again, remember, the scalper is trading on some of the lower time frames, like 15-minute and below, while the day trader might actually trade on the 15-minute, but also utilize the 1-hour time frame as well to get in and get out of the market based on specific periods of time. So again, scalpers are usually the 1 to 5 minute. Sometimes we'll use the 15-minute. You know, I would say the day trader is trading between the 15-minute time frame to the 1-hour time frame, which is more internal structure. And then we have the swing trader that holds trades for 1 to 5 days, who's more of a long-term investor. And those type of guys are trading on, like, let's say, the 4-hour or daily time frame, which is one of my favorite ways to trade. And a lot of this is just dependent on the type of style and the type of person you are. You know, if you're a little bit impulsive, you like to get in and get out of the market, okay, you might be better as a scalper. You're able to control that impulse. And if you're somebody that, you know, wants to just trade, let's say 3 to maybe 2 hours a day, and that's it, go about the rest of your day, day trading might be the best thing for you. Now, if you're somebody that's a little bit more laid back, is okay with having long-term trades and staying in those trades for, let's say, a day, 2 days, 5 days. I've even just stayed in certain trades for about 2 weeks, and you're a little bit more laid back. That's somebody like me. Okay, I'll hold trades and I'm a swing trader just by heart. So figure out what type of person you want to be. I always say, in terms of, like, let's say you don't really know where you want to be or you want to go, just stick with day trading for now. And then what you'll notice is you'll gravitate more towards the type of style that fits your personality and that fits your habits, right? So why is day trading a superpower? I say it's a superpower because it builds the self-awareness for you to be able to grow. In order to master the market, you must master yourself. And the market is filled with so much manipulation, okay, it's almost impossible for anybody to go out there and manipulate you after you master the market, right? That's what I always say. But a cool thing and some really great perks about it is you could profit on the upside or downside of markets. It's a recession-proof type of business model. Another thing is it's 100% online, so you don't really have too much overhead. Okay, there's no team, no clients that you have to worry about when you're looking at it as a business. Another great part about trading and day trading is that there's a lot of small potential risk for big potential reward. With specific strategies, you could actually go out there and calculate or risk maybe potentially a small amount to make a large amount. It's a skill set that you build and that you could take with you forever. You know, I always say if you learn it once, you will have it forever and you could pass it down to your kids. If you're just getting started right now, you're probably wondering, well, John, what should I trade? Should I start in the foreign exchange market, the cryptocurrency market? Okay, should I get into stocks? Should I get into futures? Which one would make the most amount of sense for me? So let's do a quick breakdown just of each and every single market. And then you can decide based on your budget, based on also what piques your interest, which one you would like to go into. Okay, so let's go over a quick market breakdown. So the foreign exchange market, guys, is a $7 trillion a day industry. It's the largest market in the entire world. Okay, and you're trading currencies. These are currencies like the Great British Pound, the Japanese yen, the euro against the US dollar, all currencies from around the world, and you could even trade commodities. It's open 24 hours a day, 5 days a week. You have a lot of high liquidity, and it's great for smaller accounts. If you have a couple $100 to a couple $1,000, because of leverage, you can actually leverage small amounts of capital to make a lot of money in the foreign exchange market. Now, the cryptocurrency market, you know, we're talking about Bitcoin, Solana, AVAX, or Ethereum, some of these well-known cryptocurrencies. It's a $1 trillion industry now, and it's rapidly growing and evolving and changing the way that we look at money in 2025. So I would say that it's open 24 hours a day, 7 days a week. It's very, very volatile though, and that's why it might not be the best for beginners, but because of it, you can make a lot of money, but also lose a lot of money because it's so fast moving. And a lot of it is driven fundamentally. Now, on a lower scale with certain crypto coins, you don't have that much liquidity. So you do have to be careful, okay, if you're trading with large amounts of capital in the cryptocurrency market. So I would say if you have anywhere between a couple $100 to a couple $1,000 up to $5,000 or $10,000, Forex and cryptocurrency would probably be the best thing to be able to take your small amount of capital and be able to compound it to larger amounts. Now, let's say you have more than $10,000+, then you'd be able to qualify to, get involved with stocks and futures. Now, the stock market, very simple, okay? Instead of trading currencies or instead of trading cryptocurrencies, you're trading companies, okay? Different types of companies and indices like the S&P 500, NVIDIA, Coinbase, all of these are companies, okay? And with these companies, you're able to go out there and trade in the market anywhere between, the New York session from 9:30 a.m. Eastern time to 4 p.m. Eastern time. Now, the stock market is a lot slower, but because it's a lot slower, I would say it's a lot more conservative, and it's not as volatile as Forex and cryptocurrency. Another thing about stocks is it's very news driven. And because of that, you have to fundamentally be able to read certain underlying factors of what benefit a company long-term, also what can hurt a company long-term. Then you have futures. Okay, futures is a different style of trading with contracts. And you can actually trade, certain Forex pairs and stock pairs with futures and commodities. Now, I do recommend you having over $10,000+ with certain future brokers that allow you to trade futures. But I would say it's very leverage friendly. It's fast and you can make money quickly. And like I said, it's a different style of trading here. Okay, so if you have over, let's say, $10,000+, I would say to you that you would qualify for both the stock market and the futures market. If you have anything less than that, you might be able to qualify with Forex and cryptocurrency and be able to do that. So when it comes to choosing a pair, you want to be able to just choose one or two pairs only. Okay, so with Forex, I always recommend looking at something very, very simple. A very simple pair would be like GBP USD. The reason why is because GBP USD, it respects market structure. It's not necessarily the most, I would say, volatile pair. Like let's say USD JPY. USD JPY has a lot of liquidity sweeps. It doesn't necessarily respect structure as much. Okay, so a good safe pair, a good liquid pair would be something like GBP USD or Euro against the US dollar here. Okay. Now, when it comes to, let's say, cryptocurrency, I do trade a lot of different types of cryptocurrencies, but my favorite one to look at is actually just Bitcoin, because you can make a lot of money just leverage trading Bitcoin. And it's one of the safest pairs compared to all the other cryptocurrencies. And it's something that, if you're aware of here, if you understand how to trade Bitcoin, you'll be able to understand the market direction of all the different types of altcoins that we see here on the right. Because at the end of the day, guys, Bitcoin's like the S&P 500 of crypto. Okay, so you want to be able to understand it and learn it. And yes, it's very volatile. It has liquidity sweeps, but it's nowhere near as bad as some of these other pairs here, which are really difficult to trade with, I would say. For futures, I would recommend GC1, which is just the symbol in futures contracts for gold. Gold is one of my favorite pairs. And I would say that with futures, there's a really great way to be able to leverage gold specifically. So guys, I would recommend, obviously gold here. The average daily range for gold too as well is really good for futures. What is the average daily range? So the average daily range is just the amount of points that a market will move within a day. GBP USD, it might be 100 points. With gold, let's say Forex gold, it might be 300 to 400 points in a day. So the good part about it is the more points that it moves within a day, or a pair moves in a day, the more money you can make. That also means, though, the more volatility. So you've got to be careful and you've got to be skilled if you're going to do something along that line and trade a volatile pair. And then with stocks, a good indice to just study and go out there is going to be obviously the S&P 500 or SPX, right? So SPX is a really, really good pair to just look at. Okay, the S&P 500 gives you a good insight of all stocks. And not just that, okay, it gives you a better insight, I would say, of the top 7 stocks. Like if you're looking at NVIDIA, Apple, Amazon, Google, Meta, Tesla, Microsoft, and more. Okay, if you're seeing the S&P 500 moving in upwards structure, which we're going to talk about later, okay, it usually means that all pairs are going to move in an upward structure here. Again, if you're just getting started, you're trying to decide which market works for you, pick just one pair and focus on that one pair. That way you can see success. You don't need to go out there and try to have 20 or 30 different pairs here, okay? Study one pair, and with that one pair, you'll be able to master that. I've made 6 figures off gold alone because I decided back in 2020 that it was going to be that one pair that I wanted to focus on, okay? I've made multiple 6 figures with Bitcoin just because I decided Bitcoin was going to be that one pair that I wanted to focus on back in 2018. So you have to be able to just think of one specific pair that you want to focus and study on and then go all in on that. That's just some really good things that will help you out here. Let's talk about some must-have tools. So some really good tools that you're going to want to go out there and utilize is going to be TradingView. It's a free charting tool. Okay, it's actually the tool that I'm using right now to be able to mark up charts here, guys. It's one of my favorite tools. You're able to obviously go out there, okay, and mark up certain areas. Okay, you're able to draw on it here. You're able to even look at certain zones here, like we were looking at S&P 500 earlier today. I called out some shorts here, and it actually executed pretty well. So you're able to draw lines here. Some people use trend lines. I'm not a big trend line person, but you're able to kind of see that. Okay, you're able to kind of also execute trades off of TradingView, mark up your potential risk to reward here as well with TradingView. We're going to have a whole video that's going to explain how to use TradingView and some of the best settings to be able to use TradingView as well. So TradingView is a really good tool. If you want a promo code to getting started with TradingView, all you got to do is click the link in my bio, okay? And you're going to get instant access to the right type of TradingView tools. And not just that, I'm also going to give you free access to indicators as well that you'll be able to use that'll help you understand market highs and lows with TradingView. But TradingView is, like I said, one of my favorite tools here, and I have specific settings here that I use that have helped me make really good money in the market. You're also going to want to have, okay, a trading journal. I'm going to give you guys access to a trading journal in my free group. I have a free WAP group below where you'll be able to access a trading journal where you'll be able to track all your trades. And most importantly, also have some market biofeedback and have some expectations for yourself and goals for yourself when it comes to trading. A lot of trading is built on self-awareness. So you have to be able to build your awareness. And we're going to do that with the trading journal. Also, you're going to want to choose a broker. So there's certain platforms that you're going to use and also certain brokers that you're going to use. So for crypto, you might use Blowfin, Bybit. For a broker, you could use anything that's involved with MetaTrader or TradeLocker or ActTrader. There's going to be different types of platforms that you can use and different types of brokers that you can use. The brokers that I use are going to be below. There's a couple of them that I use. I've used about like 10 of them, okay, from both crypto, Forex, futures. There's so many that I've utilized. Also, a really great tool is going to be forexfactory.com. This is optional, but if you're brand new here, I think it would be very good if you're in crypto, futures, stocks, or even Forex. 100%, you need to be able to understand how to read the economic calendar. It's going to affect the market. It is 100% going to affect the market direction of any currency pair, crypto pair, commodity, or whatever it is that you're trading. So let's talk about when the market moves and the different sessions. Now, some of you guys here might be thinking, well, John, I'm looking at Forex. I mean, I'm not looking at Forex. I want to look at stocks. I want to look at crypto. But it's actually very important to look at the Forex market sessions. And the reason why is because the foreign exchange market actually influences every single market in the world. Its economic calendar influences crypto. It influences stocks. It influences penny stocks. It influences every single crypto meme, commodity, whatever pair you're looking at in the world bonds. The whole market is influenced by the foreign exchange market. So it's important to understand some of the fundamentals of the foreign exchange market before we get deeper into whatever market you're looking to get into. You have 4 different markets. You have the Sydney, Tokyo, London, and New York. So the Sydney market is opened at 5 p.m. Eastern time until the next day at 2 a.m. Eastern time, which is the 4th largest market in the world. Then you have the Tokyo session, which is the 3rd, open from 7 p.m. Eastern time to 4 a.m. Eastern time. And then you have the London market, which is open at 3 a.m. Eastern time to 12 p.m. Eastern time, which is the 2nd largest market in the world. And then you have the New York market, which is open at 8 a.m. Eastern time till 5 p.m. Eastern time, which is the #1 market in the world. One thing you're going to want to pay attention to is on the right, the London and the New York market. These are 2 of the largest markets. And I always say there's a specific time you're going to want to get into the market, and it's going to be the overlap between the London and the New York market. Whether you're in the stock market or whether you're in the cryptocurrency market, whether you're in, just trading Forex, that overlap is where there's the highest amount of institutional volume that's coming into the market. So that's when you're going to want to start executing trades between the time of 3 a.m. Eastern time and 12 p.m. Eastern time, Monday through Friday. Okay, you want to avoid the low volume midday chop around Tokyo session and Sydney session because there's not that much volume and not that much institutional execution. Because of that, you could set yourself up for traps and you could set yourself up for being in a trade longer than you need to. What makes a good pair? I always say that a good pair is made up of high volume, clean structure, and it respects price action. As long as you have those 3 things there, okay, you'll be able to make money on a pair. Now, there's certain pairs that are not that good, and there's pairs that are very low in liquidity and they have a lot of whiplash, okay? Some good pairs in the foreign exchange market, like we've talked about, Euro USD, GBP USD. These are USD conservative pairs. Let's say in crypto, it would be Bitcoin, Solana, Ethereum. In the stock market, NVIDIA, Amazon, even the S&P 500. Now, some pairs that you're going to want to avoid are going to be pairs, let's say in the foreign exchange market, the USD CHF. Why? If you notice it, it's only 5% of the most traded currency pair in the world, only has 5% of the market share. And the Swiss franc is not that, I would say, liquid. And because it's not that liquid, it's very volatile. So it doesn't respect market structure, and structure isn't really clean. And you're going to understand that better. What is structure? Structure in a market is when a market is moving to the upside, coming back down to the downside, coming back up to the upside, coming back down to the downside, and creating higher highs and higher lows, higher highs and higher lows, and then higher highs and lows. That's called clean structure. Okay, a USD CHF is sometimes not that clean of a structure, and it will not create clean structure. And because of that, it's not necessarily the best type of market to trade with. I would say with crypto, something that you're going to want to avoid is very, very low liquidity crypto coins, like crypto meme coins. A lot of them are just driven off of hype, and fundamentally, unless you have a strategy behind it, technically, it doesn't respect structure. So I wouldn't look at anything like that. When it comes to, I would say, the stock market, I would try to avoid like lower tier penny stocks because they can be very manipulated. And when it comes to, let's say, futures, any low liquidity pair as well. So let's talk about TradingView. One really good thing about TradingView is you're able to mark up your zones, okay? On top of marking up your zones, you have the ability to be able to go out and back test your ideas, track your plan, and use candles, not lines in a chart. Okay, so like I said, we talked about TradingView earlier. One thing I really love about TradingView, it has so many different features here. And what we could do is we could actually start with a very clean chart here. Let's start with a clean AUD USD chart here. Let's remove all 58 drawings. Now, one cool thing about TradingView is you can easily just draw on the chart. You'll be able to learn whether or not something is in an uptrend, in a downtrend. You'll be able to understand whether or not, okay, we're bullish or we're bearish just by zooming out, okay, of the market. Another cool thing about it is you'll be able to find areas of interest here, okay, that you're going to want to look at. Certain areas that I could see price reject from, right? You can mark up certain areas of interest, certain zones here, external zones. Also areas that you could potentially look for buys, right? Another cool feature with TradingView here is you could actually, look at this, you could actually back test this. So let's say if I'm here and I'm just randomly back testing to a random chart, or I jump to a random area, I can actually go over here, go to the tool section. Let's say I believe that the price of the market is going to jump over here. I'm going to take a short position right at this, around this equal high area specifically. And I believe the price is going to come above here, fall back down. And I believe that because of, let's say, a certain area, or I have Fibonacci area. Okay, and I believe price is going to come right down here. Okay, cool. And so the area of interest that I'm looking to sell would be like potentially here. Okay, and then what I could do is just press this play button and I could see if that trade executed or not, right? Now it did miss that area. It actually came right above here. And you can just do that here. I went to a random place and just tested this out, right? So again, that's the really cool part is you could back test your ideas, whether they're good or bad. You could also track your plan with TradingView as well. And you could use candles, not just line charts here. And you have the option of doing hollow candlesticks, volume candles. I always just recommend regular candlesticks here. Okay. So know your order types. So there's going to be different types of order types that you're going to take, and you're going to either enter the market directly through market execution through either a limit order, then you're going to have a stop loss and a take profit area. So let me break this down here directly. Let's say we believe that the market is going to head to the downside here. Okay, with AUD USD. And we have a short position lined up here specifically. Let's say we've analyzed the market on a hypothetical standpoint, and let's imagine that we're already looking at shorts here and we believe that it's going to come back down to these lows. Okay, let's say the time right now, it's 1 a.m. We believe that the markets, we're looking at this live and we believe right before news, it's going to drop. If we pull something through market execution, it's immediately going to put us in that order, okay? Immediately put us in that order. And then what's going to end up happening is I directly would get into the market. Now, let's say it's earlier in the day. Let's say I'm sleeping at night by 1 a.m. And let's say it's 8 o'clock. We're right here at this time frame, okay? If I set a limit order, right, a limit order, what that basically means is when the market, let's replay it again. If I set a limit order, if I believe that price is going to turn around at 0.66208, okay? Let me replay this over here. Let's say it is 7 o'clock or 8 o'clock, okay? There we go. As I'm sleeping, as long as I put a limit order here, it would get me into the market as long as price moved past this specific area. Okay. And then move to the downside. That is a sell, known and recognized as a sell limit order. Okay. Now, a buy limit order would be the opposite. If I am looking for a buy limit order would be something similar. Whereas if I'm looking for, let's say the market is moving to the downside, okay, and my limit order is here, a buy limit order would be where a price would immediately, let's say I place the buy limit here, and then I go to sleep, the market does its thing overnight, and a buy limit order would then execute once price crosses this specific area and then crosses back to the upside, right? That would be a limit order. A lot of you might be thinking, well, John, what about these specific areas? What is the stop loss and what is a take profit? So when I'm entering the market, okay, I have a belief. I have a belief that the market is either going to move to the upside or it's going to move into the downside. So in a very simple way, we have to be able to figure out what is our belief. What is it that we're looking to do? Are we looking to buy or we're looking to sell? I'm going to teach you a strategy here later today. But one thing I want you to be aware of on a fundamental aspect is when we're entering the market, whether it's a market execution or a limit order, we need to know what we're risking and what we're looking to gain from that trade. So let's say in this specific trade, I'm risking anywhere between, let's say, $10 here, okay, in terms of total risk, okay? And this is a 1 and, let's see, it would be a 1 and 3 trade to make potentially $30 here. Okay. If that is true, and if that is the case, my stop loss total volume here is going to be just $10. Okay. And I'm going to use a calculator later to show you guys how to calculate this in the foreign exchange market. But let's say it was, let's say, the price of a share. We're not looking at AUD, but let's say this is a regular, on a hypothetical standpoint, regular market. Let's say this price was $100 and our stop loss was at 110. I mean 110. And then our take profit was at $70. We set the pending order here. The market would do its thing. Okay. And we're risking a potential $10 loss to make about a $30 profit. Make sense? And then we would let it execute. Now, why is a stop loss and take profit important in the market? Why is that important? The reason it's so important is because the market is very volatile. And anybody that tells you they know exactly where the price of something is going is lying. Nobody knows. Why I say that is because you want to be able to protect yourself like insurance. I have a video that talks about risk to reward, but you could have, let's say, a negative win ratio, and you could still make money in the market with a small risk to reward. We'll speak about that later. Risking only $10 gives me peace of mind knowing, okay, hey, look, I'm only taking a $10 risk for a $30 reward. And this is going to help you because in the long term, that $10 is eventually going to be a $100 risk to make what? $300. And then eventually, like some of the trades that we take, it's going to be a $1,000 risk, okay, to make, $3,000. And then I'll show you guys some of the trades that I've done before as well, where it's a $10,000 risk, okay, for a $30,000 profit, okay? So eventually this grows. You get that peace of mind understanding what you're risking and understanding where your stop loss is going to be and where your take profit is going to be. Now that you got those order types in, let's go over now how to place a trade. So what you're going to want to do is you're going to want to pick a pair. Then after you pick a pair, you're going to decide your bias, whether you're looking to buy or sell. And then you're going to understand your risk. I always recommend to everybody to not risk more than 1 to 3% of your account max per trade. And then eventually, if you're swing trading, you can kind of scale. Now, I'm going to break that down more in depth a bit later. After you do that, you're going to set a risk to reward and also your stop loss and take profit. And I'm going to show you guys a live example here with Forex. So let's say
we decide to do this with Euro USD. Okay, I could mark it up here on TradingView. That way it's easier for me to be able to see. And I see right now, obviously, Euro USD is broken structure here, a little bit more bearish here, at least on the daily. And bearish just basically means I believe the market is more on a downtrend here, obviously from this impulse wave here. And if my belief, I see that it did break this area here. Okay, 1 second. That there. Go on a lower time frame here, respect that zone. Okay, cool. So if I believe price, just because from what it looks like, I believe price is kind of redistributing. I believe price is going to go down. I'm going to short this position here. Okay, all I'm going to do is I'm going to look at the areas here on TradingView where I would put my stop loss. Now, my stop loss is going to be above the previous highs here. Those are areas of where liquidity lies. Okay, most people's stop losses are going to be above that zone, so I just want to be right above it. Okay, and I am going to want to sell probably right back when it retests that area here. And my profit, I'm going to want to take profit right at, let's say if it drops past this zone, I could see price probably, wow, come back down here. This gap, did it break? In a hypothetical scenario, let's say we believe price will come back down to this zone here. So this is a 1, and let's just do it for this specific example, a 1 to 5 trade. Okay, so it's around a 1 to 5, right? Now, what I would do is I would take these coordinates here and now insert them into my trading platform. Now, the trading platform we're going to use today is going to be TradeLocker. So TradeLocker is pretty cool. I also use MetaTrader 4, MetaTrader 5. I'm also a big fan of ActTrader as well. It just depends whatever platform you plan on using, but I'm using TradeLocker for now. And I'm going to show you a demo account now in this example. Now we're going to place a trade. Now, in order to place a trade, let's first calculate, obviously, the lot size and the breakdown of how we're going to place a trade, specifically with this Forex pair here, because we're going to be trading Euro USD. Now, remember, there's going to be a different measurement based on the brokerage that you're using and also based on the pair that you're going to be trading. In the foreign exchange market, at least, we're going to do the calculation. A standard lot in the foreign exchange market is a 1.0, or considered a $10 per pip. A pip is just a point in the market. Okay, so if the market moves, let's say with Euro USD from 1.1567 and it moves up to 1.1568, that is considered 1 pip. Okay, 4 decimal points after where the decimal point is. Very simple. $10 with the 1.0, if we leverage a 1.0, that is equivalent to $10 per pip, okay, on a hypothetical standpoint. Now, 0.1 is a mini lot, which is $1 per pip, essentially, and a micro lot, which is 0.1, which is 10 cents per pip. I like to do this here just because it gives a better sense of what you're risking, okay? So a standard lot, essentially in the foreign exchange market, is 100,000 units, which is equal to $10 per pip. Okay, it's 100,000 units of a euro, which is leveraged, which is why when you're actually trading a standard lot, a 1.0 in Forex, you're actually trading about 100,000 units of a euro, which is why 1 pip is equivalent to $10 from that unit of measure. A mini lot, which is a 0.1, is equivalent to 10,000 units now of a euro in the Euro USD example, which is $1 per pip. So if the market moves to 1.1566 to 1.1567, okay, that is equivalent to you making $1 on a 0.1. On a micro lot, a 0.01, that is 1,000 units, which is equivalent to 0.10, 10 cents per pip. So again, what is a pip? A pip is like a point, okay? It's the smallest price movement in Forex. In most pairs like Euro USD, 1 pip is just 0.0001. It's just a unit of measure. So if Euro USD goes from 1.1000 to 1.105, that is a 50 pip move. That's 50 points. If I were to trade, let's say, a mini lot, that is equivalent to me making 50 bucks. I were to trade a standard lot, that's equivalent to me making about $500. Now, the great thing about Forex here is you can actually utilize a lot of leverage. So with a 1 to 200 leverage, let's say your broker lets you control $200 for every $1 in your account, which is really cool. Now, if you have $1,000, you can control up to $200,000 in trades, which is why you could actually compound your account very quickly here. So now I'm going to place a trade. So now let's go over here to TradeLocker to place a trade. What we're going to do is something really simple. We're going to go and place we're going to place the same exact order that we talked about here, and that's going to be the sell limit. So let's go over here into pending. We're going to click sell. Okay, we're going to sell at the specific price that we talked about earlier, right here. We're just going to copy this. We're going to paste it right here. That's going to be our pending order. And then what we're going to do is we're also going to take the stop loss here. We're going to copy the coordinates, and then we're going to place it right here. Okay. So now I'm aware of what I'm risking here. I'm risking a total of $283 to potentially make about a total of $1,446 here. So you see that? Now, obviously, our risk here is a bit higher, so I could lower the lot size here, but this is about 3.01% of the account. So I'm leveraging about 3% of the account on this specific trade. I always recommend for anybody to go out there just when they're starting off to just, on a larger account, only risk 0.5% to 1%. And if you're just getting started, make sure that you're demoing here and you're utilizing a calculator. We have access to a free calculator in our free group that you can utilize, so that way it makes this easier. But then what I'm going to do is I'm going to set the sell limit and then just wait for the market to then execute my order. Now, if I want to do a market execution, like I believe the market is going to move now, then what I would do is just simply go over here and instead of, setting up a pending order limit or moving it around, because that's what you can do with Trade Locker here, what I'm going to do is I'm just going to enter the market, sell by market, and risk a 1 lot. And then it's going to enter me into the trade. Now my pending order here, I'm going to move over here to positions, and you'll see it here live right now. Super simple. Be able to enter the trade and start taking orders immediately. Now, remember, sometimes with lot size formulas and calculating your risk can be very difficult, like we've talked about. If you want free calculator or access to calculators to be able to do this and have it just calculated for you, all you got to do is go into my WAP group and I give you free access to indicators and also calculators. So then that way it can be calculated for you. So you don't have to go out there and try to calculate it yourself. Some people like to break it down on a mathematical standpoint. Here is the example below on a mathematical standpoint on what it would look like. Let's say you have an account size of $10,000 and your risk per trade is 2%, which is $200. Stop loss is 50 pips. Your pair is Euro USD. You have a 1 to 200 leverage. The way you would calculate it, you would take $200 divided by 50 pips. That's $4 per pip that you could afford to lose. $4 per pip to stay within your $200 max risk. Step 2 would be, since $10 divided by the pip is equal to 1 lot, it'd be $4 divided by $10, which is a 0.4 lot size that you would use. So the final lot size that you would use is a 0.4. And then all you would have to do is adjust that compared to, like, let's say if you're trading with $1,000 or even less. Now, again, this is the mathematical standpoint on how to calculate this. Okay, if you do not want to calculate this, all you have to do is go into my free group. Okay, we give you free calculators, indicators to be able to calculate this as well. So then that way you're not over here, okay, pulling your hair out, trying to figure this out. Now, let's talk about risk to reward. I think risk to reward is one of the most valuable things that you can learn when it comes to trading. And I kind of mentioned it briefly, and it's the only way that I trade. Risk to reward is key because you could actually be a terrible trader. And I don't want to say this in a negative way, but you could have a low win ratio, but still be profitable. A great example of this is, like, let's say if we were trading with Euro USD, if we had a 1 to 3 risk to reward or a 1 to 5 risk to reward in this example, let's say our first trade, we took a loss and we lost 10 pips. At a lot size of 0.1, hypothetically, we would lose $10. Okay, with trade number 2, let's say we lost again. We took another setup, we saw it was a 1 to 5, and we lost 10 pips. It's another minus $10, not including the spread and the swap, of course. Let's say our third trade, we actually win this trade, and it's a $50 pip trade or $50 point trade on a 0.1. That's plus $50. Okay, that would actually mean right before swap and before the spread, we would have a net of about 30 pips, okay? Or a net profit of $30. And we lost 60% of our trades. Only one of them really hit. That is the beauty behind risk reward. It keeps you in the game long term. And understanding this is key to be able to sustain, let's say, a prop firm challenge, or even go out there and sustain your own trading account. So you want to set up the right parameters. Like let's say if your goal is to catch, 50 points in the market a day or pips,
You're only going to take a 1 to 3 risk to reward. Only setups that are going to give you, okay, a $10 risk to a $30 gain. Very simple. Or a $100 risk for a $300 gain. Or a $1,000 risk for a $3,000 gain. When you get really good and you have a good strategy, you're going to start taking trades where you have maybe a $1,000 risk for a $10,000 gain. And I've taken some of those live that you can check out on my YouTube, or you can check out in my free group. Reward per trade. You're also going to split up your lot sizes as well, because that's going to help you. And realize that risk reward is ungodly important in order for you to succeed. And it does a lot of the heavy lifting for you as well. Because again, you don't have to have the highest win ratio, but it keeps you alive. So set your stop loss and take profit. Like I said, it's your GPS. Certain rules here. Stop loss, take profit to lock in gains, set up both when you enter, and only take trades that are a 1 to 3 risk to reward. Remember, we're going to be taking trades like I've given out for free on some of my live sessions that are even 1 to 7. The better the risk to reward, the better your results. Just remember that. Now, I'm going to talk a little bit about my trading layout here. I'm going to talk about TradingView. I'm going to talk about broker execution, also just some of the calendars and certain news events that I look for, and a clean setup and some clear decision making here in the market that I specifically take. So let's talk a little bit about technical analysis, learning how to read price on a chart. Technical analysis is huge because it's 1/3 of trading. I would say it's the largest third of trading. You know, you have technical analysis, fundamental analysis, and then also sentimental analysis. Okay, but let's talk about technical today. Now, when it comes to technical analysis, you have to be able to identify patterns, levels, and even certain flows. When you're looking at a chart, you're actually just seeing human psychology playing out in live time. And a lot of this human psychology has structures. It's not random. A lot of it is coming into play. Just realize when you are buying and selling, you're selling and buying against somebody else. Okay? So all this is, when you're looking at a chart, is just emotions and numbers and emotions and candlesticks. Now let's talk about the anatomy of a candlestick. If you look to the left right here, you'll be able to see how candlesticks work. A green candlestick, okay, is going to represent when price goes up or when price is quote unquote bullish. A red candlestick is going to represent when price goes down. The wicks represent the high and low range, and the body represents the open and the close. So when the market opens up right here, over here to the left, and it closes below the open price, it is a bearish candle. Now, what do these wicks represent? The wicks represent that the market at one point in time, okay, was above the open price, which means this was somewhat bullish and it looked green. Obviously, there was more sellers in the market, so it pushed price down. Now, the wick to the low also represents that price was actually lower than the closing price. But in this example here, like let's say this is one trading day for one candlestick. By the end of the trading day, the market pulled back up and closed right here. The same can be true for the candlestick on the right. Only difference is this candlestick closed bullish or it was a price up. Green candlestick. Okay? So price opened up at this zone here. And at one point, price had actually got lower than the open price, which means that this candle on the daily looked lower and looked red at one point and was lower than the open price. What ends up happening is more buyers got into the market and price ended up moving to the high side and even was higher than the closing price. But before the end of the day, closed right here, it ended up being bullish. Just understand the anatomy of a candlestick. And I like to look at candlesticks specifically, I would say human emotion, but most importantly, like representation of price action. It's one of the most accurate ways to go out there and trade. So let's talk a little bit about support and resistance here, and let's talk a bit about market structure. I think market structure is one of the most crucial things to learn when it comes to trading specifically. I don't like to look at support and resistance, I would say, on a chart consistently, because a lot of times people don't do it correctly. You know, a lot of times people are looking at support and resistance, okay, and trading off of support and resistance, and that's not a good thing to do. You don't want to trade just strictly off of support and resistance. But on a visual standpoint, I want you to understand the theory. When price has a ceiling, it comes back down and tests a floor. And the market always has these things called ceilings and floors, where it'll always go through specific areas of ceilings and floors, and it'll touch these areas multiple different times. A great example is this. The market started here, moved to the upside, hit this ceiling, came back down, respected this previous floor area, went back up, okay, created and went towards a ceiling area right here, went back down, went through a previous floor area in the past,
came all the way back up to a previous floor, which is now a ceiling area, came back down to a floor area, which was over here, came all the way back up, broke the previous ceiling, which is now the new floor. Now it's going into another ceiling over here, rejected, came back down into the floor, broke past that ceiling, which is the new floor, came back down, broke the floor, went back up, broke all those ceilings, and went back to other ceiling over here. Okay, so why do people trade this way? People trade this way because it's the easiest way to be able to see the market. Now, I don't specifically trade this way. We teach institutional method, which actually goes against this here, but it's good for you to see this here in the beginning, so that way you have an idea of what's going on. Now, one thing I want to look at specifically is going to be market structure and why market structure is so important, because you're going to want to trade only with the trend. And we have an example right here. You can kind of see this as resistance, support, resistance, support, resistance. I wanted to use it in this example. Now, what do I mean by that? We can look at the market here live right now. Let's look at this little section right here. And we can look at the trend. Now, if we're on an 8-hour time frame, I'm going to teach you guys something real quick. The 4-hour time frame and above is known as external structure. The 3-hour to the 15-minute is considered internal structure. And then the 10-minute below is considered microstructure. One thing about the trend is if we're on an uptrend, and what's an uptrend? The market moving to the upside. We are only going to look for buys in that market. And we're only going to look for buys because we are on an uptrend. Look at this. It's the 4-hour time frame. So that means we're only going to look for buys. We don't want to trade ever against the trend, because the largest movements of the market here are the buys. Yes, there are some sells that end up happening in the market, but those are called pullbacks. But the largest moves in the market here are buys. You don't want to trade against the trend because the trend is going to go against you. You want to trade with the trend because you have the largest opportunity to make money trading with the trend versus trading against it. You see what I'm saying? You have lower probability. You have the ability to make money, just not as much. The risk to reward is not there. And when you're trading with the trend on the 4-hour and above, it puts you on the right side of the market. So the trend is your friend. What defines a trend? Very simple. If you don't see this that well, the way that I marked it up, you could use the line chart so it helps you see it a little bit better. All a trend is a market, okay, creating, I'm going to use these circles over here. Okay. A starts from a low to a higher high to a lower low. Okay. To lower high to a higher high to a lower high and then to clone again to a higher high. See that? So we have a lower low, a low to a higher high to a lower low to a higher high to a lower high to a higher high. That is known as a trend. Sometimes it's easier when you see it on the line chart here, right? But on a 4-hour structure, this is what it is. Okay? The key to recognizing structure is always trading with the trend and always trying to figure out where you are, okay, in the market. Are you in this is what most people call an impulse move, or are you in a correction right now? Is the market moving to the upside in an impulse, or is it correcting at the current moment? The way you make money in the market and you stay profitable, and I made 6 figures just off this one strategy alone, is looking for the impulse move and then just getting in the right area for corrections. So you're looking for buys in these specific areas here. You're not trying to buy all the time on the impulse move if you're right here, because you're looking for where the correction ends so you can get in the second or third impulse move here. That's one strategy that will make you guys a lot of money. Okay? And the market does this on every single time frame. So you can look at these impulse and correction moves everywhere. So if we actually close this out here, you can go to any time frame, any chart, and you could see the whole market doing this here, right? You could see the whole market just doing impulse and correction moves, impulse and correction moves, impulse and correction moves, uptrend, downtrend. Here you would just sell. Here you would just buy, right? And you have correction, impulse, correction, impulse, correction, impulse, correction, impulse. See, on a downtrend. Again, impulse, correction, impulse, correction, impulse, correction, impulse. Very simple. You want to trade with the trend and train your eye to be able to see this. So entries, like we talked about, they come from the pullbacks. Impulse is the strong move, and the pullback is the market breathing and retracing. So a great example of that is this right here. Let's say we're looking at this specific impulse move. Or, actually, oh, I lost you. Lost you guys. Okay. Whoa. Okay, a great example of that is going to be, let's say we're looking at this specific area, like a random area, like right here. Okay. This specific correctional move. Okay. The pullback is the market breathing. And the best entries come from the pullback of structure. Okay. So again, let's do this here in live time so you guys can see it. What do we have here? We have an impulse move. We have a correctional move. We have an impulse move here. We have a correctional move. Okay. And then we have some people would call this an impulse. It is not an impulse. Why is it not an impulse? Because price did not break above. Okay. Look at this. Or did it? Let me see. Did it? If it broke above, then technically it is an impulse move. And it created I think it did. Yep. And it created a lower low. Okay. So this is technically an impulse move here. And then we have a correction. Okay. A lower high. Higher high. Perfect. Okay. A little janky here, but that is what it is. So, and then some people on a higher time frame would consider this one impulse move. That's what I would consider this one, to be honest. But in this example, yeah, let's trade it like how I would trade it, to be honest. One impulse move. Okay. So if I'm looking at this as one impulse move, because I trade on the 4-hour, 8-hour, 12-hour, and daily. I'm a swing trader, guys. This is how I would trade it. So if we're looking at this correctional move specifically, there's two areas that we can look at. We could either look at the whole impulse move if we're trading on multi-time frame Confluence, and this is some advanced stuff, but what I'm looking for is something simple. Okay. I'm just looking to see the pullback and where the pullback is going to go, right? So I'm going to draw my Fibonacci level. Very simple. And I see that this is the impulse move here. And I could see that price is getting towards the 38.2, which in Fibonacci is one of the most, I would say, important numbers, because price is always attracted to the 0.382 or the 61.8 or 7 or the 0.716. And we're going to talk a little bit more about that. Okay. Now, what you could also do, this is some advanced stuff here. So you could draw multiple levels of Fibonacci, and you could see that price actually pulled back, and you have Confluence, which is double confirmations of the 0.38 and the 0.5. Okay. 50% area, both coming back down to these levels here in that zone, and then pulling up to the upside here. Right. So again, the money's made on the pullback, and then the market pushes to the upside here. Okay. The best entries always are after the pullback in structure. And how do you add confirmations? You add confirmations with the wick, a candlestick, sometimes the session, or what I just showed you guys, Fibonacci, being able to use Fibonacci. And you draw the Fibonacci from the low to the high of the impulse move to measure where you believe and where you see the correction is going to go. So let's talk about time frame mastery. We spoke about this briefly, but I think it's important for you to understand. Higher time frames always dictate the market direction. Lower time frames help you with refinement.
So they align you for better precision. So you don't want to get stuck on one viewpoint. And this is the reason why. On the daily, this chart here is very, very much bullish, okay? Meaning that we are looking for buys. Looks like it's completely shifted structure, right? Because why? It's on an uptrend. But more importantly, it broke this previous impulse move right here, okay? Structure was broken from the previous, okay, impulse and correction, bearish impulse and correction moves over here. See that? And because we broke that zone, what it did was it officially made this very much bullish and an uptrend. Okay? Now, why is that important? Is we're only going to be looking for buys. Now, at one point, obviously, we're trading on the daily, so these are the span of months. If you're on the, like, let's say 1 hour time frame, or even you can go to the 5-minute time frame, this thing looks completely different. And if you're only looking at, let's say, the 5-minute time frame over here, like, this thing looks like it's going to sell off completely. And if you don't know better and you didn't see the daily, all you're looking for is sells. And then you're getting sells at the absolute worst time, because then the market would move against you. And now you're screwed and you're holding thinking that the market's going to come back, or this is what most people do, right? And it never does. The key is to have multi-time frame confluence. How does that work? Very simple, guys. What you're going to want to do is you're going to want to obviously, okay, look at what the 4 hour looks like, because 4 hour and above is considered external structure. Okay. You're going to want to see what the 1 hour looks like, if the 1 hour is bearish or bullish. And then you're going to want to combine that with what the 15-minute looks like for entries and the 5-minute looks like for entries. So on the 5-minute, this could look bearish here. 15-minute, it could look bullish. The 1 hour, it could look bullish. And the full hour, it could look bullish. When these all align perfectly, it's really good, because that means on the 5-minute, you have a good area for a pullback to enter into the market, because long-term, we know that for the 4 hour, 1 hour, and 15-minute, we're going to be bullish. So you can make some money. Multi-time frame confluence is very key to be able to see and read a market. Some of you guys might be confused here. Don't worry. It's going to take time to see it. I have a free course in my WAP group that's going to teach you all about this. And it's very simple. It's not that difficult here. But you're just going to want to match timeframes with one another. So if this right here looks like it's about a buy, then what we're going to look for is only buys in this chart on the 1 hour. On the 4 hour, it's very much bullish. So that means it's confirmation we're going to buy. 1 hour confirmation we're going to buy. The 15-minute, it looks like a little bit of a sell. So we're not going to sell. We're not going to buy on the 15-minute. We're going to look for a pullback, potentially this specific area here, right? That I would see right there. That specific zone. And that's how we would determine multi-time frame confluence. And then on the 5-minute, looks like a good buy. Again, you want to have time frame mastery and be able to calculate all this here to get better precision into your entries on a day trade. So let's talk about some bonus concepts here. See, most people out there are going to teach you the retail concepts, which are complete garbage. Okay, all the retail concepts, guys, okay, are going to have you lose money. Most people are trading support and resistance. They're using the 61.8, the 38.2 Fibonacci. They're using all these indicators, a million different indicators. Anybody that has a million different indicators on their chart, you should run. Be very careful, okay? A lot of times, these guys are very dependent on lagging indicators. If you're only dependent on, candlestick formation, support and resistance, you're probably getting wicked out. And it's because the reality is, smart money, or institutional trading as well, combined with algorithmic trading, which is what we do, is actually how the institutions trade in the market. And it's based off us, obviously showing you where the institutions are buying and selling. We have specific indicators that show you where to buy and sell based on the institutional flow. The best way to really understand where the market is going is to understand smart money concepts a bit more. We break it down in depth so anybody can understand. There's a lot of nonsense, a lot of garbage there. And a lot of smart money concepts have been, I would say, also gatekept and hid away where it's been overcomplicated, and some of them don't even work based on the way that they're being taught. So like liquidity sweeps are a good thing to learn. Fair value gaps, I do not like it at all. I think it is complete waste of time. Again, this is why we teach smart money and institutional trading the right way with algorithmic trading tactics. It helps, but you want to use it in confluence with what it is that you're doing. Let's talk about a quick checklist here. And if you want a smart money training, all you got to do is go into my free group. I give you a full-blown training on it and a course on it as well. So before you enter trend direction, that's the first thing you're going to want to look at. The second thing, you're going to want to look at a key level. Okay, a key level, basically, I don't want to say this support and resistance because I don't trade support and resistance, but you're going to want to look at an order block or a key level at a fib level, let's say on the trend. Then you're going to want to look at confirmation. Let's say you're trading at the right specific time. And then you're going to want to look at your risk reward. Let's say you're trading with a 1 to 3. And then when all 3 to 4 things match up, then you're going to want to execute. And if it doesn't check out, skip it. For the first couple of years of my trading journey, all I focused on was just trend direction and Fibonacci, and then looking at a key level, not support and resistance, but another specific indicator like support and resistance, like supply and demand, which we teach as well in the free course. And that's it. All I looked for was trend direction, a key level, and making sure my risk to reward was there, following market structure, and I would make a couple thousand bucks. Then you would just execute. Now, let's talk about your trading plan here, because I always say that having a trading plan really rewards you. And if you don't have a plan, you're planning to fail. Okay. So having a trading plan removes all emotion. It creates related responsibility, repeatability, and it just reduces your bad decisions because it helps you bring awareness into what works and what doesn't work in the market. So we do have a trading plan that I do want to share with you guys. I'm going to pull it up right now here so you can see it. So let me pull it up right now. What you can do is if you go into our free WAP group, you'll be able to get access to this trading plan immediately and see it. So all you got to do is click on the link below and we have access to this trading plan. I got it from a friend of mine a while ago. So what this does is it helps you calculate your beginning balance and your weekly pip goal. Also, it helps you record the pips for each day that you're using the pip tracker to be able to calculate your risk. So let's say we start with a balance here. We could change this here to about, let's say, I don't know, say $10,000. Now we'll have an idea of what our pip goal would be. Let's say for the week, our goal is to catch, let's say 250 pips, 50 pips a day, keeps the 9 to 5 away, right? Lot size would be a 0.1. That's what we would use, okay, for our profit target goal, okay? Because let's say we're looking to make anywhere between 2 to maybe even 0.5% on every single trade, okay? And it also gives us our pip goal based on our balance, our lot size, and the net pips and our net profit. And then what we could do is actually track what we did and how many pips we caught each and every single day and the actual results that we got. On top of the trading plan, you also get, okay, a confirmation checklist here. So this gives you an idea of, hey, what am I looking for? What is my ideal setup? Let's say it's a break of structure, right? Or a pullback, multiple time frame confluence, and then that engulfing pattern. We also give you an idea of what your own confirmations are going to be right here, and then what your exit strategy is going to be, what to do when you exit the market. For me, once I'm in profit, I set my stop loss to break even, so it's a free riding trade. Then I always set 3 take profit areas, and I look for fib levels as well. Then you also have the ability to get your free trading journal here. So this trading journal here, you can basically put the date, time, pair, buy, sell, lot size, risk reward. Most importantly, the confirmations that you saw, and then the results. The greatest part about this was the market biofeedback that I saw. So let's say if you were looking at AUD/USD, you want to monitor your feelings before the trade, during the trade, and after the trade. And then what went well and what didn't go well and what you need to improve in. That way you have a better understanding of what's happening and also a better understanding of what you're feeling during the whole process of a winning and losing trade. So that way you become less emotional and you start trading with discipline. So you get access to this all in my free group as well. Create a daily routine. For me, I like to wake up in the morning, review different types of news, fundamental news, and then during, like, let's say 30 minutes or an hour before the session, really do positive things here, take a shower, get myself in the right type of headspace, and then start this session. Absolutely crucial when you're day trading to be in the right frame, in the right state of mind in order to be able to have successful trades. If you're not there, and your psychology is off, it's gonna affect your trading 100%. I've seen some of the best traders in the world go on losing streaks or lose money just because their psychology wasn't there. and their brain isn't operating at its maximum capacity. In the afternoon, you're going to want to review, log, and then just set a reset, maybe go to the gym, and then obviously journal your wins and losses. So again, the trading journal that changed the game for me helps you record your trades, log your losses, track your best setups, and spot patterns to optimize your trading. Now, my biggest advice here, okay, is to use a template very similar to this to be able to track it. Understand what market you're looking at, the pair you're looking at, the strategy you're using, timeframes, the risk, and the goal. Very simple. Focus on one setup. Absolutely key. I always say that if you just get one setup, like the one that I gave you guys with market structure, okay, a pullback, Fibonacci, you should see some sort of results here. And then trading at the right time with maybe a fundamental indicator, it's going to help you a lot. So you want to repeat one high probability setup consistently and execute it at least 30 plus times before switching. Learn your edge inside and out. Again, consistency always beats complexity. You don't want to overcomplicate this thing. If you want some additional help, we do offer that. We offer group one-on-one coaching to be able to help you and get a better strategy so this makes more sense. I gave you guys 3 to 4 confirmations that you could look for. Very easy that you could use right now. But as you get more advanced, there are way better confirmations for you to be able to utilize. Remember, this is the trading tracker that I use. Track everything. What you track grows. If you track your business, it's going to grow. If you track your trading, naturally, it's going to grow. Again, your first strategy, identify the right levels. Wait for a clean break of structure, look for a retest or confirmation, and then execute with proper risk reward. So again, setup checklist here that I'm going to give you guys. A clean trend direction, a well-defined support and resistance zone or supply and demand zone, a retest of structure, confirmation candle or wick, and a minimum 1 to 3 risk reward. Very simple. What are we looking for? Clean trend direction here with Euro USD. Okay, so the clean trend direction is bullish. Okay, a well-defined support and resistance zone. You know, we could look at the well-defined support and resistance zone would be either here or here, or some people would consider this right here as well. For me, I like to look at supply and demand zones, which is right here. That's what I would use as a confirmation. And then a retest to structure, not a random spike. So another area that I would look at would be right here. So I'm waiting for the retest of this structure point, not just that spike. Confirmation candle or wick, right? This is a nice confirmation candle, institutional, at a minimum 1 to 3 risk reward. So based on this fib level here, this would also take us to what? The 50% area. You see that, guys? Right. So all I'm looking for now is a buy in this area here, the 1 to 3 risk reward. All I'm looking for now is entry here, stop loss below this candle, low, supply and demand zone, or some people call this a support and resistance zone. And then I'm looking to go back to this area right here. And this would be for me, the highs, go back to the highs would be a 1 and 5 trade. So we're doing even better. A 1 and 5 to these highs. Simple. If you want more specific help with this, feel free to message our free Discord community. We'll be able to help you out there. If this doesn't make sense, trust me and believe me. In the beginning, it does look like hieroglyphics, but it's very, very simple to understand. So there's certain mistakes that you're going to want to avoid. The one is going to be entering during a breakout candle, placing stop losses inside of noise, no confluence, and then chasing price on the emotion. A good example of this is like entering a market during a breakout candle. A lot of times people will see that the candle will break out right here, okay? And they see this breakout candle, they immediately will place an order right here from the breakout candle, okay? And most people, they see that and they think that they're going to make a lot of money here. So what they're doing is they're placing the order on the breakout candle thinking, oh my God, this thing is going to spike up to the upside. And then what ends up happening is they end up risking a 1 to 1, right? Let's do this right here. Okay. And then the market just moves against them completely. So you don't want to move on a breakout candle, okay? It's probably the mistake that 90% of retail traders make. It's like the moment they enter, the market reverses. You don't want to place stop losses inside of a bunch of noise either. You don't want to place a stop loss in something like this here. This is just market consolidation and noise. You're just going to lose money. Another great example is no confluence and just guessing. I gave you guys like 4 confirmations to look for. If you just look for one thing, you're going to lose money. You need a plan. You need about, I would say, for me, it's 3 to 5 confirmations that I look for. Once those 3 to 5 confirmations that I look for are good to go, I'm ready to go. It's called confluence. When there's no confluence, I don't trade. And then tracing price on emotion. You don't want to chase the price because the price, it's like trying to catch a falling knife. It's dangerous. You don't want to do that. So let's talk about some of the next things here. You know, on our next session and in our free group, we're going to talk about confluence on an edge, trend alignment, zones and session timing, and then obviously smart money confirmation and candlestick and volume confirmation. Okay, this is also taught in our advanced mentorship as well with one-on-one coaching and group coaching. So, you know, guys, it took me months and even years to be able to learn this here. And if I could go back, I would actually have, you know, because I've learned from a lot of teachers, wish I would have found my teachers earlier because I would have made a lot more money a lot faster and saved 10 years of time doing so. So if you're here and you're looking for coaching, we can definitely help you out and save you 10 years of knowledge and information to be able to get you to win faster. So again, guys, one setup is going to give you unlimited potential, and look for that setup consistently. Repeat it the same setup maybe 30 to 50 times. Journal each result, optimize your stop loss and take profit over time, and then you're going to scale with confidence. So what's after this next setup? Okay. What we're going to talk about, okay, in Trade by Design is going to be order blocks, liquidity zones, more institutional and algorithmic trading concepts, and also in-depth confluences. So what can you do right now? Just subscribe for more high-level breakdowns. We're going to be breaking down really high-level concepts. Okay, comment below what is your biggest takeaway. Any questions that you have, I'm going to answer them 100% and give you guys all the free resources that we have here to help you grow. You could also download the free trading journal in our group, in our WAP group. So just make sure you join the WAP group, and it's going to be in the resources page there. And then you could join the free community to ask any additional questions. So guys, I actually want to congratulate you because you are one of the few that not only just went through this video here, but probably took notes and really understand how we day trade now. Not just some of the concepts, not just the fundamentals and the terminology. You actually understand the market as a whole and can read it just with this one training alone. So this is a skill for life. Again, progress always compounds if you stay consistent, and you don't need to trade every day. You just need to trade with the right type of intention. So your journey starts right now.
I've coached thousands of traders, and I know from experience that consistency in the right community can change everything. That's why I created a free Discord group so you can network with like-minded traders and also get feedback. That way you can learn and grow together alongside with each other. So here's what you can do right now. Subscribe to this channel to get some free trainings every week, and make sure you leave a comment with your biggest takeaway from today's video. I read every single one and also answer all your questions, so that way you can get the right type of solution. I'll see you in the next session, guys. Peace.